Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts and waiting for the ChargePoint earnings call to start. So I've got us all connected. Just need to turn on the audio for you guys. And let's see. Just making sure. Yeah, so let's see, 1 second. Sorry, I'm fumbling around a little bit. Yeah, so gotta turn on the audio for you guys, and then just looking over at the chart, did see pretty nice spike in the after hours going up to 72 cents, but then getting rejected from there. Not really sure why, but it is up 2% in the after hours, so it's not too bad so far. It does look like they got a beat, I believe, on sales. They So it looks like 101.89 million, which was a beat of what was expected or estimated of 101.71 million. So a little bit better there. EPS, earnings per share, down 14 cents, it looks like, which was in line with the estimate. And yeah, so their revenue for quarter one was 95 to 105 million versus 101.53 million. So yeah, I mean, I think, looking good, but, not like insanely good or anything. I do see a comment from Jose saying that this is the most important earnings for ChargePoint, might change their future and ours. Yeah, so I was pretty excited when I saw this spiking up there. But yeah, I mean, we are below purple downtrend. Also, we did close 66. I've got this red line here at 66.20. So we closed just below that. That was the low that was hit on February 11th. And so, yeah, I mean, I would like to see us launching higher. Got the 21-day moving average at about 76 cents. And yeah, that purple downtrend, I think that's going to be a really important one to get above. So hopefully we see something getting a lot higher over the coming days. But I do feel like if a reverse split is potentially going to be on the table with the compliance notice that they got from the New York Stock Exchange, I do feel like this could be, if it does go up higher, I feel like it could be fading lower. This purple line is June 4th, really just being approximate. In June, thinking around that time is when we might have to decide about a reverse split. And then I think that by August, that is when that reverse split would happen. And with other stocks, definitely seen the prices come down following reverse splits, so good to be prepared for that. And then Saul is saying that he agrees with Jose about this being the most important earnings for ChargePoint, might change the future and ours. Change their future and ours. So yeah, I'd really like to see this getting to above $1 a share, not only because of compliance, but just getting a little antsy down here. I've been buying the dips. I think the lowest though that I bought was 62 cents, so I could have gotten in the 50s. But yeah, just trying to also keep some cash on the side, which is tough when we're having such massively red days. But I hope you're all keeping your cools, whether it's with ChargePoint, other stocks that you hold. I was definitely being trashed a little bit on Twitter because I was talking about, I'm just going to switch over to get Ed out of the way for a second. On Tesla, I had talked about this just being at this confluence of levels here. Did close below the 200-day moving average, so a little bit weak. Might be a continuation to maybe fill this gap right here. I'm just going to make that line a little bit thicker. But yeah, I was getting trashed because I shared a video that I posted a month ago when price was up here, suggesting that price could be coming down to around 270. And they're posting all of these stuff with the, when he said, my heart goes out to you and all of that, which is really just propaganda. And so just a lot of emotion. And so kind of remove the emotion. Are you trading based on, people not having justified sentiment because of something that was misinterpreted, a mischaracterization of a CEO? Or are you making your decisions based on fundamentals? And so we're going to learn more about the fundamentals from this earnings call, which should be starting here any minute now. So I'm actually going to check this page. I'm just going to refresh it. Sometimes they start without me. Oh, it's starting. Okay, so I'm going to mute myself and we can enjoy it and watch this together. I'll put it back on the chart in a second.
Everyone to the ChargePoint
Enjoy.
fourth quarter fiscal 2025 earnings conference call and webcast. All participants' lines have been placed in listen-only mode to prevent any background noise. After the speaker's remarks, there will be a question and answer session. I would now like to turn the call over to Nandan Amladi, ChargePoint's Vice President of Finance and Investor Relations. Nandan, please go ahead.
Good afternoon, and thank you for joining us on today's conference call to discuss ChargePoint's fourth quarter fiscal 2025 earnings results. This call is being webcast and can be accessed on the Investor Relations sections of our website at investors.chargepoint.com. With me on today's call are Rick Wilmer, our Chief Executive Officer, and Mansi Khetani, our Chief Financial Officer. This afternoon, we issued our press release announcing results for the quarter ended January 31, 2025, which can be found on our website. We'd like to remind you that during the conference call, management will be making forward-looking statements, including our outlook for the first quarter of fiscal 2026. These forward-looking statements involve risks and uncertainties, many of which are beyond our control, and could cause actual results to differ materially from our expectations. These forward-looking statements apply as of today, and we undertake no obligation to update these statements after the call. For a more detailed description of certain factors that could cause actual results to differ, please refer to our Form 10-Q filed with the SEC on December 6, 2024, and our earnings release posted today on our website and filed with the SEC on Form 8-K. Also, please note that we use certain non-GAAP financial measures on this call, which we reconcile to GAAP in our earnings release and for certain historical periods in the investor presentation posted on the investor section of our website. And finally, we'll be posting a transcript of this call to our investor relations website under the quarterly results section. And with that, let me turn the call over to Rick.
Thank you for joining ChargePoint's fourth quarter fiscal 2025 earnings call. Today, I will walk through key financial results for the quarter, our recent business highlights, and discuss the anticipated shifts in the U.S. policy as they pertain to ChargePoint. We continued to execute on our mission for operational excellence in the fourth quarter and are pleased with the results. We delivered significant sequential improvement in adjusted EBITDA as well as cash usage. Revenue was $102 million, above the midpoint of our guidance range. Subscription revenue increased 14% year-on-year to $38 million in Q4. Our gross margin increased to 30% on a non-GAAP basis. Q4 non-GAAP OpEx was $52 million, which is down 42% from our high point of $89 million in Q2 of fiscal year 2024. Cash consumption reduced significantly compared to last quarter, and our ending cash balance was up by $5 million from the end of Q3. We have rationalized our cost structure, and we will continue to operate efficiently. These improvements demonstrate significant progress toward our goal of achieving positive non-GAAP adjusted EBITDA for a quarter in fiscal 2026. We finished the year with 342,000 charging ports managed by our software, of which 120,000 are in Europe and more than 33,000 are DC fast chargers. These ports drive our subscription revenue. To demonstrate our scale, between managed and roaming ports, we provide ChargePoint drivers with access to more than 1.2 million charging ports worldwide. EV adoption continues despite recent narratives to the contrary. According to the research firm RowMotion, 2024 was a record year for global EV sales volume, with North America up 9%. The firm's January 2025 data reported North American sales up 22% year over year, and Europe, including the UK, up 21%. EV sales are a natural leading indicator for our industry. As more EVs hit the road, the more chargers are needed to fuel them. Dozens of new EV models are expected to arrive this year, further expanding selection for consumers. These EVs boast features which were previously unavailable, and they are coming to market at price points closer to those of internal combustion vehicles. We believe free market forces will drive organic EV adoption in the absence of subsidies. Global automotive manufacturers, most recently Kia on February 27th, have reconfirmed their commitment to EVs, whether they continue to invest in internal combustion or not. Many institutions across industries such as retail, hospitality, and logistics are fully committed to reducing their carbon footprint. EVs remain a major part of their plans to do so. EV charging will remain the essential enabler of the transition to e-mobility. Charging sessions on the ChargePoint network continue to grow sequentially, with approximately 27 million sessions delivered in the fourth quarter. In our 17-year history, the ChargePoint network has delivered more than 322 million sessions, of which almost 30% took place during the last fiscal year. As I have said previously, we believe this demonstrates how existing EV charging infrastructure is under pressure. Additional charging capacity is moving from a want to a need. We are still seeing institutions procure charging as a marketing tactic to attract customers, a loyalty tactic to retain them, or both. Charging infrastructure has lagged behind EV adoption, and it needs to catch up. We continue to make progress on our 3-year business plan. To recap year one, we restructured, revised our product roadmap, set our leadership team in place, and put tremendous focus and effort into operational excellence. As we often say internally, focus plus effort equals results, and that is becoming apparent in the results we are delivering. We completed year one of our plan early and have a head start on year two. Year two of the plan prioritizes growth and innovation. Our next generation software and hardware products will deliver substantial innovation to the market, which in turn we believe will result in further growth. A very well-received innovation is our recently announced anti-vandalism technology. One of the industry's biggest points is station vandalism, particularly the theft of charger cables. To combat the issue, we have developed a cut-resistant cable and are offering it to the entire industry so we can collectively fight crime. This innovative approach to hardware development remains one of our 4 strategic cornerstones, and the hardware roadmap is not just limited to features and components. The first of several planned product announcements for 2025 will take place soon. Year 3 of the business plan will be reaping the benefits of this completely revamped product portfolio, which includes our next generation software platform that will drive profitable growth. In terms of growth, like with innovation, there will tangible results in Q4. The biggest highlight was a collaboration with General Motors' GM Energy division. Together with ChargePoint customers, we plan to open a significant number of GM Energy branded DC fast charging locations this year. ChargePoint is uniquely placed to deliver this for GM, thanks to our market position and our relationships with the industry. The program is intended to offset upfront investment with an owner-operator subsidy. This enables our customers to reduce their ROI threshold and accelerates the growth of their network. It will drive sales of ChargePoint solutions in parallel. As proof of its appeal, we managed to open the first location within 4 weeks of finalizing the program. While there is much in the news regarding the uncertainty of U.S. federal funding for DC fast charging infrastructure, there is still funding available at the state and utility level. In Q4, we completed 6 fast charging corridors across the state of Colorado, doubling charger coverage on those roadways. We are also near completion of a series of fast charging locations in New York State. Neither of these large-scale projects is federally funded. Despite operating in a turbulent macro environment, we believe the transition to electrified transportation is inevitable. I will now touch on the policy direction of the new U.S. administration and the possible implications for ChargePoint, beginning with tariffs. Over the past 2 years, we have geographically diversified our manufacturing and warehousing relationships. We manufacture globally and have the capability to increase production at any of these facilities, including those located in the United States. The proposed tariffs on raw materials are inconsequential relative to the total cost of manufacturing our products. Regarding the future of the National Electric Vehicle Infrastructure Program, which represents the U.S. federal funding being pulled back, ChargePoint does not own and operate charging infrastructure. We do not sell electricity to drivers, nor are we reliant on federal funding. Overall, NEVI-related deals represented an insignificant portion of our revenue in 2024. Therefore, we do not anticipate these changes to have a material effect on our business going forward. In conclusion, ChargePoint is leading the EV charging industry, retaining our significant market share. We have rationalized our cost structure to improve our financial performance for our shareholders. ChargePoint is the most diversified business in the EV charging sector by use case and geography. We have an expansive customer base across AC home, AC commercial, and DC high-speed charging, spanning both Europe and North America. Our dependence on federal projects is minimal, and everything is in place for growth this year. We are confident we can deliver. I will now turn the call over to our CFO, Mansi Khetani.
Thanks, Rick. As a reminder, please see our earnings press release where we reconcile our non-GAAP results to GAAP. Our principal exclusions are stock-based compensation, amortization of intangible assets, and certain costs related to restructuring and acquisitions. We are very pleased with our Q4 results. All the focus and effort we put into operational excellence throughout last year is bearing fruit, and our Q4 results were a proof point of that. We delivered significant improvements to our gross margin profile and brought OpEx down to appropriate levels, which materially reduced adjusted EBITDA loss. This reduction in adjusted EBITDA loss, combined with a reduction in inventory and better working capital management, resulted in significantly reduced cash usage for the quarter. As we have mentioned before, we expect total cash usage to continue to be close to adjusted EBITDA loss or better as we sell through inventory. We saw this in Q4 and expect this trend to continue. Revenue for the fourth quarter was $102 million, above the midpoint of our guidance range, which was $95 million to $105 million. Network charging systems at $53 million accounted for 52% of fourth quarter revenue. This was flat sequentially and down 29% year-on-year. Looking ahead, we believe we will start seeing improvement in these year-on-year growth rates. Subscription revenue at $38 million was 38% of total revenue, up 5% sequentially and up 14% year-on-year due to the recurring revenue generated from a higher installed base. Other revenue at $11 million was 11% of total revenue, up 4% sequentially and up 33% year-on-year. From a geographic perspective, North America made up 81% of fourth quarter revenue, and Europe was 19%, consistent with recent quarters. Non-GAAP gross margin was 30%, improving 4 percentage points sequentially and 8 percentage points year-on-year. This is attributable to higher hardware margins due to improved costs and higher subscription revenue. We expect margins to continue around this range going forward and further improve in the back half of the year, subject to revenue mix. Non-GAAP operating expenses were $52 million, down 11% sequentially from $59 million in the third quarter, and down 30% from $75 million in the fourth quarter last year. This OpEx level is now appropriate for our business needs. However, we do expect a modest increase going forward due to annual salary increases and investments in certain key areas of the business. Non-GAAP adjusted EBITDA loss was $17 million, a fifth consecutive quarter of improvement. This compares with a loss of $29 million in the third quarter and a loss of $45 million in the fourth quarter of last year. Stock-based compensation was $15 million, down from $21 million in the third quarter and down from $25 million year on year. Our inventory balance decreased by $13 million to $209 million, the second consecutive reduction from an all-time high in the second quarter of fiscal year 2025. This reduction in inventory freed up cash and helped reduce our cash usage in the quarter. As we have mentioned on prior calls, selling through existing inventory releases working capital and generates cash, which occurred this quarter, and we expect this to continue in the future. We ended the quarter with $225 million in cash on hand, up $5 million sequentially. Our cash used for operating activities declined significantly to just $3 million during the quarter, down from $31 million in Q3. This was due to lower operating expenses, higher gross margin, reduced inventory, and other improvements to working capital. Note that due to our capital-light business model, cash used for operations, as shown on our statement of cash flows, is very close to total cash consumption for the quarter. While we continue to rigorously manage cash, we have access to a $150 million revolving credit facility, which remains undrawn. We have no debt maturities until 2028, and we have existing capacity on our ATM. With respect to full fiscal year 2025 results, revenue was $417 million, non-GAAP gross margin was 26%, and non-GAAP operating expenses were $243 million. From a geographic perspective, North America was 81% of full-year revenue, and Europe was 19%. For additional full-year fiscal 2025 results, see the press release issued earlier today. Turning to guidance, for the first quarter of fiscal 2026, we expect revenue to be $95 million to $105 million. This is almost in line with Q4 at the midpoint, despite Q1 typically being a seasonally lower quarter. In conclusion, we believe Q4 was a pivotal quarter for us. Our results reflect the ongoing benefits of all the measures we took over the past year in terms of gross margin improvements and OpEx reductions, all of which improved adjusted EBITDA loss. We are entering fiscal 2026 with streamlined operations, a significantly reduced cash burn profile, and a strong balance sheet. Continuing on our fiscal 2025 trends, we will focus on operational excellence and execution to achieve our goal of being adjusted EBITDA positive in a quarter during fiscal 2026. We will now open the call for questions.
Thank you. We will now begin the question and answer session. If you have dialed in and would like to ask a question, please press star one on your telephone keypad to raise your hand and join the queue. If you would like to withdraw your question, simply press star one again. If you are called upon to ask a question and are listening via loudspeaker on your device, please pick up your handset and ensure that your phone is not on mute when asking your question. And your first question comes from the line of Colin Rusch with Oppenheimer. Please go ahead.
Thanks so much, guys. Thanks so much. Now, can you talk about what the optimal working capital balance looks like for you guys? It looks like you probably have some inventories that you can draw down, but receivables and payables are probably around the right levels here. Just want to get a sense of getting that in line.
Yeah, hi, Colin. So typically, if you look at quarters before last few years where we had this huge supply chain issue where we started that right after that started building up our inventory, if you look at quarters prior to that, we actually generate positive working capital. And this is mostly because of the SaaS effect of our subscription revenue. We get paid upfront for the entire portion of the contract value, and that's why our deferred revenue balance is high, and that generates actually cash for us, which helps working capital in a significant way. Going forward, though, I think it balances out with inventory needs, payables, etc. But this is not a business that requires significant amount of investment in working capital.
Great. And then just, a broader question, given the rationalization of, a lot of the players in the space, can you talk a little bit about the competitive landscape and how that's shifting and how you see, potential share gains coming through the balance of this calendar year?
Yeah, I think on that, Colin, we're watching it very carefully. Obviously, different players in the market, whether they're in North America or Europe, and depending on how they play and how much they depend, for example, on government subsidies, are impacted in different ways. We've all seen some participants go out of business, some other players exit the business, and we're, again, paying attention to it very carefully.
Great. Thanks so much.
Your next question comes from Mark Delaney with Goldman Sachs. Please go ahead.
Yes, good afternoon. Thank you very much for taking my questions, and nice to see the margin progress. Last quarter, you spoke about green shoots in demand as you considered factors like the scope of projects and the timing as to when your customers wanted to deploy incremental charging capacity. Could you give a bit more on what you're seeing in terms of the project pipeline for this coming fiscal year and what that might mean for your revenue growth?
Yeah, as we've discussed, this is the year where the two big themes are revenue growth and innovation, and we fully expect to capitalize on both. In terms of demand, again, I alluded to this in the prepared remarks, but what we really believe is that improved vehicle selection, both the form factor of the vehicles and the price points of the vehicles, are really going to help pick up demand. We saw that in the growth numbers year over year. And again, we really believe free market forces will win the day and are firmly convinced, based on all kinds of data, including firsthand experience, that EVs are just superior to internal combustion vehicles. And we've now hit a 10% market penetration in a big portion of the U.S. and most of Europe. And at that level of penetration, you've now got enough EVs on the road that people that have not experienced them or seen them are now seeing friends drive them. They're having an opportunity to try them themselves. And as people, again, experience the superiority of the product, they're just going to switch. So like we mentioned, we believe the move to EVs is inevitable. It's going to happen regardless of whatever government programs support, the growth of the industry or not. With that said, we've got a lot of commercial institutions that are in parts of the world where there's a lot of EVs on the road, and they fully realize that if they don't offer EV charging, the people that they care about aren't going to come to their institution. So we're seeing, strong demand continuing in commercial. In the case of fleet, we're now starting to see real tangible data that's showing that fleet customers are actually lowering their cost of operations and exceeding, quite frankly, their expectations with an electrified fleet compared to an old internal combustion fleet. So there's a lot of positive signs that are translating into business for us.
This is very helpful. My other question was about the mix of business. I think typically you disclose billings by vertical. Apologies if I missed it, but could you talk a little bit more around how the mix of the business has evolved, what it came in at during the fourth quarter, and any go-forward commentary, and was that a factor in the gross margin pickup as well? Thank you.
Yeah, so the mix was pretty similar to what we normally see. Commercial was 68%, fleet was 16%, residential was 12%, and the rest other was 4%. Very similar to trends in the past, nothing different there. And the gross margin improvement was not really related to the mix here. It was more related to better hardware margins and higher subscription revenue as a percentage of overall revenue.
Thank you.
Your next question comes from Bill Peterson with JP Morgan. Please go ahead.
Hi, good afternoon. This is Mansi Khetani on for Bill Peterson. Can you maybe touch on how your current sell-in rates and sell-through rates are trending? And are distributors still taking on new product now or waiting in anticipation of policy certainty and perhaps improving EV demand trends?
Again, this is a year of driving growth, and we see demand out there that needs to be fulfilled. So I don't think there's been any shift in that area that's been evident to us as a result of any administration policy changes. In terms of the way the channel is working, it's business as usual. I haven't seen any change as well in terms of the take rates or the sell-through rates of the channel. And now we've been in a place for a few quarters now where the channel inventory is normalized. So all that is operating well, and we continue to grow our channel program. That's part of the overall plan to drive revenue growth this year.
Got it. Thank you. Can you also touch on if you expect any changes to your contract with the USPS, given the GSA's recent move, to remove chargers from its properties?
So far, no news. We're still moving forward with USPS deployments, but obviously, like everything that's affected by government policy changes, we're keeping a close eye on it.
Okay, thank you. Appreciate it.
Your next question comes from Stephen Gennaro from Stifel. Thank you. Please go ahead.
Thanks. Good afternoon, everybody. I think two for me, but I'll start with subscription margins, which were very strong. There seems to be, the last 3 years, some seasonal strength in the fourth quarter, and I was wondering if that was coincidental, if there's a trend there for fourth quarter seasonality, and just kind of how we should think about subscription margins going forward.
Yeah, so the benefit we get in the fourth quarter, Stephen, is that our subscription revenues tend to be higher, and obviously the costs don't have to scale along with revenue, so we always see a nice margin boost. However, we expect this to continue or actually even improve through next year because we're going to continue to see economies of scale as our subscription revenue keeps growing. We've mentioned in the past we're investing in automation on that side of the business, and we're expanding in low-cost regions.
Yeah, the other comment I'll make is that a major element of cost of goods sold on the subscription side are cloud hosting fees. And as Mansi mentioned, we've got the economy of scale now where we're able to negotiate some of those costs down. And in addition, we're moving into a hybrid cloud environment where we've got more than one source for cloud services, which gives us additional leverage to drive cost of goods sold down on the subscription revenue side.
Great, thank you. And my follow-up, and I dropped off before, so I apologize if you answered this, but anything on the supply chain for chargers and the tariff issues and how that could impact demand from your customers?
So as we mentioned in the prepared remarks, luckily for us, we diversified our manufacturing footprint substantially over the last year and a half. We've got factories in multiple countries now, including the U.S. So based on everything that's been announced thus far and put into play, and even to some extent things that have been rumored to put into play, our analysis shows that we should not have a major impact on our supply chain and therefore COGS as a result of tariffs.
Great, thank you.
Again, if you would like to ask a question, please press star 1 on your telephone keypad. That is star 1 on your telephone keypad. We'd like to wait for a few seconds, just in case.
Yeah, someone just queued back up.
We now have Mark Delaney from Goldman Sachs. Please go ahead.
Yeah, thanks for taking the follow-up questions. One I was hoping to better understand is what you're seeing in terms of the decoupling between hardware and subscription revenue. I know that created some potential opportunity for you on the software side, also perhaps could be a headwind as well. So if you could elaborate on what you've been seeing, especially in the North America market with that dynamic.
Yeah, Mark, that trend continues. We've now, I believe, have literally well over 100 different non-ChargePoint hardware models that we manage with our software. And we're seeing that trend of a bifurcation of a software buying decision and a hardware buying decision continue. And we believe with our leading edge software solutions, that puts us in a great position to continue to drive software subscription revenue that may be disassociated to some extent with our hardware sales, again, because we can manage, all kinds of third-party hardware with our software, and we're watching that trend continue.
Very helpful. Another topic I was hoping to follow up on was around permitting. I think there have been some challenges with permitting that have led to some push-outs. I don't know if you've seen any progress from that perspective that you can speak to.
No substantial progress. It's kind of steady state where you'll see some deals that you expected to close in a quarter get moved either because of permitting delays, grid upgrades, available of grid infrastructure equipment. And that is, I think the trend has kind of stayed consistent there where it hasn't really improved or deteriorated compared to the way it's been the last couple quarters.
Okay. And maybe, sorry, maybe just one last one for me. You maybe could talk about the mix of hardware business going forward. Mansi, you talked about pretty flattish gross margins in the near term, and then a pickup in the second half, subject to mix. So I don't know if you could elaborate around what you're contemplating there, and what we should be watching for in terms of mix dynamics that would be helpful, and what might be a headwind. Thanks.
Yeah. So what I meant in terms of mix was if mix shifts significantly in one direction or the other, that might impact it. So I just wanted to qualify my commentary. There is no mix shift expected. It's been pretty consistent actually over the last 4 or 5 quarters. But as I mentioned, we will see benefit or improvement in margin in the second half of the year, more than what we already have seen in Q4, mostly because of improvements in hardware margins due to product coming from our Asia manufacturers and improvement in our subscription margins with economies of scale.
Got it. Thank you.
Your next question comes from Craig Irwin with Roth Capital Partners. Please go ahead.
Thank you for taking my questions. The first thing I wanted to ask is back to Office. This is something that impacts a historically very important customer base for ChargePoint. All the technology companies, particularly on the West Coast, that put in charging for their employees. Are you seeing a back to Office play out as a little bit of a tailwind for you guys? I know historically it's been a high margin mix. Is that something that could potentially benefit you over the next year or two?
Yeah, good question, Craig. I think in general, when we think about the commercial segment, one easy way to subsegment it is into retail and non-retail. The workplace, schools, universities, libraries, et cetera, all fall into the non-retail side of that category. And we continue to see strong growth there. I think in the workplace particularly, we see people continue to have pressure on their chargers and employees getting dissatisfied. When they arrive at work, they can't find a place to charge, so we see continued growth there. Hard to say if it's actually directly correlated with return to office, but overall, both in the retail and non-retail segment of commercial, we're seeing growth.
Understood. Thank you for that. So then, Mansi, your team's done a really good job squeezing the balance sheet for cash. Can you maybe talk about opportunities in inventories and prepaid as far as potential contributions to cash flow over the course of your fiscal 26?
Yeah, so we will continue to see inventory coming down as we saw over the last 2 quarters. And as that happens, as you already pointed out, this will release working capital. It adds to our cash balance. So we'll continue to see that. Payables, deposits, all that stuff is kind of stable. There'll be a little bit of movement here and there, nothing major. But the 2 main things that will drive, cash are one, inventory, and the other one is reduction in adjusted EBITDA loss. And as that keeps improving through the year, the amount of overall cash needed will decline. Due to our capitalized business model, we have very minimal CapEx requirements. So our cash flow from operations is a very close proxy for total cash consumption. You saw that this quarter, our cash usage from operations was just $3 million versus $31 million last quarter. That's why our cash position was so strong. But we'll, as inventory keeps going down over the next few quarters, we'll keep seeing a positive impact on cash.
Understood. Thank you. Thanks again for taking my questions.
Again, if you would like to ask a question, please press star one on your telephone keypad. We'll just wait for a few minutes. Again, that is star one on your telephone keypad. There are no more questions at this time. Ladies and gentlemen, that concludes today's call. Thank you all for joining. You may now disconnect.
All right, so there's that. I'm just going to disconnect from their call, so we're not listening to that. And I did put in the description of the video a link to their press release, so if you guys want to check that out, you can. And also, I did put timestamps. They're approximate, yeah, it was a short call. I kind of wonder why the one that was this morning that I did, Plug Power, was quite long. It went into the open, which is a little frustrating because I wanted to, I feel like we all probably wanted to get on to focusing on our trades and or whatever else. So, yeah, I mean, it's kind of nice when they're short. In all honesty, I have a really tough time paying attention to getting information out of earnings calls just because I need I need to be actively listening. I need to be engaged with the person who's speaking. And so on calls and stuff, I just kind of zone out a little bit. But I did, pick up some details regarding tariffs. I think that they are in a really good position, it sounds like, because they have factories in different countries. But if there are issues with importing some of the stuff or, whatever, they can increase production, whether that's in the U.S. or abroad. So I think that they're positioned really well as far as that goes. So that's encouraging. And yeah, and I kind of wonder, I was given a hard time this morning. I mentioned at the beginning of the video about Tesla and Elon Musk and how people are, spray painting Teslas and stuff like this, just like really stupid stuff. Whether, in all honesty, whether you like or dislike Elon, Tesla and companies that he has founded and or leads now, they produce the best stuff. And I feel like great examples of that are EVs becoming competitive. That's because of Elon. And space flight coming back to the US. That's because of Elon with SpaceX. And if it wasn't for him, we would be relying on Russia for sending astronauts up to the space station, recovering them from the space station. And so we are now independent from Russia because of Elon. And then also just the stuff with Neuralink, just completely incredible. I'm wondering if I wasn't aware of the blindness thing, but just the idea that if somebody's paralyzed because of some accident, if a chip could either stimulate them to be able to regain motor function or, kind of paired with Optimus, if they're making, body parts, basically, if those could then be controlled by a Neuralink chip. And so maybe an amputee could then, have basically making androids have a Optimus arm or something that they could control from the chip. So I just think that he's involved in so many groundbreaking things. And I think a big criticism, there was a clip of AOC saying he's not a scientist, he's not an engineer, all of this stuff. But, I think that you have to really take a step back, and ask yourself, was Steve Jobs a genius? Did he really change the world in an impactful way? Or did he just, I think Bill Burr has kind of a comment on this, it wasn't, it was never just Steve Jobs. It was always like this uh, army of nerds behind him, but they never came out for the presentations. But the iPhone was invented because of ideas that Steve Jobs had. And I think same thing with Tesla and SpaceX, all of that. These things, companies like ChargePoint, don't exist just because of they exist because of people who are trailblazers, like Steve Jobs, like Elon Musk. And unfortunately, we lost Steve Jobs. We have not lost Elon. And so I think that if Steve Jobs would still be here, he would be involved in a lot of controversies. He was not a rule-following person. He, was frequently not wearing shoes, all sorts of stuff. So I think that, anyways, whether or not that hurts or helps Tesla or EVs, I think that controversy might, lead to some diversification of charging stations, people leaving Tesla, but maybe still wanting to be with EVs. So then they get a different, an EV manufactured by a different company, and then turn to other charging stations like ChargePoint. So I think that, that could be good. But anyways, that's enough rambling there. Matt is saying, thoughts on why EVgo is worth more than ChargePoint? I don't know. I think it might be because I believe that they have a faster charging station. I might switch over to my EV charging list, which I don't really look at. But yeah, so ChargePoint has a market cap of 292 million as of close. EVgo is about 3 times that, 752. My understanding is because that they are fast charging stations. And then also just to get a little comparison here with Blink, this is a market cap of less than 100 million. And so of these, I mean, I feel like Blink and ChargePoint have the most potential to the upside. And EVgo, I don't know. I mean, and I just kind of look at the aesthetic of the charging stations. I find ChargePoints to be much more appealing, more attractive than EVgo, more attractive than Blink. But at the same time, that doesn't really matter. I mean, all 3 of these companies could end up going bankrupt. It's really tough to say. And Blink and ChargePoint are now both below $1. Blink, it looks like, it's just been fading lower for quite some time. But where is the dollar marker? Yeah, so it really just kind of flirted with $1 over here on February 12th, but then broke lower, now residing lower. Earnings coming up for them on the 13th. I'm not sure if I'm working that day. I am working starting every day next week, but only 8-hour shifts. So I'm not sure if I'll be able to cover their earnings call. But to be honest, earnings calls are always kind of tough for me, and they don't necessarily attract that many views, that much traction for the channel. So it's kind of not necessarily the best use of time and energy. But yeah, I mean, with ChargePoint, I was just noticing this during the earnings call. This blue line, I just made them thicker so they're a little easier to see. That's the 200-minute moving average. Not sure if that is technically that significant, but we can see that we were, below all of these moving averages at the start of the day. And now we are below the 50-day, which is the yellow line, or this would be the 50-minute. And the 21-minute is the kind of peach-colored, salmon-colored, pink, whatever, colored line there. But we are holding above the 200-minute moving average. Still, even though we've kind of broken below it for a few minutes, but for all of those minutes, ended up closing above it. So I think that's kind of an important level. We did, let's see, a previous low, I believe, was 66.20. So it would be nice to see it holding that. So yeah, we'll have to see. And I did note this. I think the low for today was 57 cents. And so who knows, how volatile it is For me, I placed just a limit buy for another 100 shares at 57 cents. But, to be honest, I may remove that and I may just kind of chill, trying to just like sit on my hands this week. I've got some property taxes due in a month, and rather than taking money out of savings to pay for that, I kind of just want to use my paychecks to pay for that, and so I'm trying to be a little tight as far as buying, whether that's with ChargePoint or any of the stocks. And yes, I'll just get back to the chat over here to follow up with Matt, who continued on. Federal funding keeps failing companies going. Pulling this funding may be good for established player ChargePoint in the long run. And I think that's also kind of the argument that Elon has made. Earlier on, the tax benefits really were like Tesla wouldn't have been able to survive without the stimulus, what's it called when they not the stimulus, but the incentives, the tax breaks, whatever. I'm drawing a blank on the word, but now that Tesla is established, those tax breaks would only really benefit the newer companies, and that would actually, and withdrawing those funds would actually just benefit Tesla because the smaller companies would suffer more. And so that ChargePoint has been around for a little while. They're probably in a better shape. But still, it's a pretty small company compared to something like Tesla. And so Matt is saying, not a lot of questions. Was it Rick being concise or lack of interest in the company? So Rick is the president and CEO, so I think that he was probably just being concise. And also some of the questions were like redundant in what they had addressed earlier about tariffs. And it might just be that maybe people are just exhausted from the trading today. And so maybe they have other bigger fish to fry or something like that. And so Jose is saying that I'm confused. Nothing on the stock future value was discussed on the earnings call. Yeah, and actually, I wonder if maybe that's something that they're not really able to talk about too much because they did get the compliance notice from the New York Stock Exchange, and maybe they would have to have a vote for shareholders regarding a reverse split. So maybe it's just something that they're not able to talk about too much. And let's see. Saul is saying, I think the call wasn't that bad. And I feel like it was, for me personally, I have a hard time absorbing information from them. It was digestible for me. As far as the news on tariffs, financially, it seems like they're doing fine. And over here it says, solid Q4 report, Q4 guidance. I think this will be a pop-up here, so maybe I can just read this. ChargePoint Holdings released its fourth quarter results after Tuesday's closing bell. Here's a look at some details from the report. I can't click on that, but the details. ChargePoint reported quarterly loss of 14 cents per share in line with analyst consensus estimate. Quarterly revenue clocked in at $101.88 million, which beat the analyst consensus of $101.71 million. So really just barely beating it, but still. Non-GAAP gross margin was 30% as compared to 22% in the prior year's same quarter. So that's good. Trump tariffs will raise prices within days, Target CEO says, but they might actually walk back those tariffs from the post that I saw from Unusual Whales, which I can pull up here. So Unusual Whales, U.S. Commerce Secretary Lutnick has said Trump may roll back Canada and Mexico tariffs tomorrow. So, I think that he's really just using that to, kind of seesaw the markets, keep people on edge, and also use it as leverage against Canada and Mexico. Now, let's see what this notification is. Okay, so, let's see. 165 posts. Maybe there's something new here that we might see that's related to. I like Canada, but the threat of boycotting Old Orchard Beach is the funniest thing. I'm not aware of that. Let's see. Lutnick Okay, so both Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president is listening because, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think that he's going to figure out you do more and I'll meet you in the middle. It's a negotiating tactic. So I think that it's, not really that bad of a thing. It's a negotiating tactic. And so, yeah, that's something to be paying attention to. Trying to keep up with all these headlines right now. Tariffs incoming. It's over. Tariffs canceled. We're back. And also good to follow Chart Norris. He posts some stuff on dogs and funny things. Keep things balanced. Let's see what Colin says here. Wouldn't get too excited about any after-hours moves till after Trump is done tonight. I feel the exact same way. He's supposed to be speaking tonight. That may rocket things higher or may, rug pull us. Who knows? Just Colin's 2 cents. And let's see. Deal incoming. Blanket tariffs may have lasted just one day. Lutnick. Trump may roll back Canada-Mexico tariffs tomorrow. Lutnick. Tariffs compromise. Announcement likely tomorrow. So, so good to be nimble. And yeah, I probably might end this stream just because I got to get some groceries and because I kind of want to relax, play some video games. I got Donkey Kong Country Returns about a week ago, and I haven't played it that much. I kind of want to relax. I got work tomorrow in the morning. Probably won't have a video out tonight just because I did these 2 streams. And I get burnt out if I do too many. So hopefully there's value in this. I will catch up on the comments though. And so Matt continued, earnings call, never talk about stock prices. Yeah, they never do. What reverse splitting, Matt? And so the reverse split might happen because they got a non-compliance notice. Let's see if I can scroll over here to maybe I can search. I wish I could search this. But let's see. There should be something here from like a week ago. Oh, okay, yeah. So can you see it above my head? ChargePoint faces New York Stock Exchange delisting risk amid growth and security push. And let's see over here. You can barely see it. ChargePoint receives non-compliance notice with New York Stock Exchange listing rule because of being below $1 a share for a certain amount of time. And so this is from Seeking Alpha. I think that'll be a pop-up. This one down here, ChargePoint intends to cure the... so this is what I want. ChargePoint receives notice of non-compliance with New York Stock Exchange trading share price listing rule. And so let's pop this up. I guess there's no real information on that, but that's just being below $1. And so what I suspect will happen is that, I kind of went over this in a video, I believe. But just, if we get maybe a squeeze up or some move up to about $1, I feel like we would then see a fade. And then by the time of around June, we would have to vote upon a reverse stock split. And that's basically like, the stock is below $1, we have to do a reverse split. And so it would be ill-advised to not do that because otherwise the ChargePoint could be delisted and then we lose all of our money. And so I would think that we get a vote around June on that happening and that to happen around August because I believe 6 months following the non-compliance notice, which came out on February 19th, or right around then, they got this. The news hit on, the 21st, but the notice that they got was on the 19th. And so by August 19th, I think that we would have to have a reverse split. And so with that, I think that there's going to be more bleeding. So I think it's good to be, if we do get some violent moves to the upside, good to be nimble with that. And one thing I'm going to look up is just ChargePoint, not investor relations, but short interest. So let's take a look at that. And so I might actually do short interest percentage float. And so hopefully we get a little summary here from Gemini. And so currently it's around 29, 30. Oh, sorry. Oh my gosh, you guys have not been able, I apologize. I was not showing my display. I was showing this. So, I guess I'll take a step back. What I was talking about earlier was some of these posts. I was reading this from Geiger Capital. And then also I apologize for reading it without you seeing it. I got this little meme there. I was reading this. I did repost it, so you can check it. But this is Lutnick's comments on the Mexican and Canadian tariffs may be walked back tomorrow. Let's just see what yeah. So Gwyneth, I don't know. This is kind of sketching me out. I've been posting more. A lot of times I'll get a female liking a post, and I feel like they're bots. Maybe it's a female who's interested in stocks, but I feel like it's not, because they tend to be pretty hot. And so I think they're like hot bots or something like that. But anyways, I was going to be talking about this 29 to 30% short interest. And if we do scroll down, what is short interest percentage of float? I think, anyways, I'm not going to read all of that, but above 20%, which we are seeing, from March 3rd, over 30%, it looks like. And that is really, high short interest. So that could potentially lead to a squeeze. If I do open up unusual whales over here, we can see from the data over here, we can look at the Greeks for, let's type in ChargePoint to see what the max pain is for this week. Max pain for this week is $1. We're below that, so I don't think that there's necessarily going to be a gamma squeeze or gamma ramp potential unless we're closing this Friday above $1. But next Friday on the 14th, it looks like max pain is 50 cents. And so if that remains at 50 cents, and also, March 28th and April 4th, 50 cents. So if we're above those prices, if we're above $1 for next Friday or the end of the month, beginning of next month, I think that could lead to a gamma squeeze, and we could get something like this. But for me personally, what I intend to do is, I think my average is around $2. I'm not sure. I plan to trim pretty heavily if it gets up to around my break even, just because I feel like, for me at least, this is I'm too heavy with this for the amount of risk, the amount of speculation with it. And so I plan to trim, especially if there is the possibility of a reverse split over here. But I would still like to hold some shares. I just kind of want to lower my risk profile with this one. But yeah, I mean, you guys do you. And so I'm just sharing what I'm thinking about doing. But as of right now, at these prices, I am only planning on adding at sub $1, not planning on trimming until it goes much higher. And Saul is saying, added a few shares right now. Yeah, I mean, I think that it's a fine time to do that when it's below. Yeah, I mean, when it's sub $1, and really, I've got this alert here at 72. I mean, when it's below 72, I think that's a pretty good dip buy level as well. And, especially if we start to see it, moving higher following, what I think was a pretty good report. And Matt's saying, just following up on these comments, yeah, they also have 6 months to get back above $1. And there's like kind of there's fine print with the $1 thing. It's not just like one close. I think that they need to have maybe 30 consecutive closes above $1 and close the month above $1, something like that. But it's not just get above $1 and then it can go back down. It needs to be maintaining price above $1. So good to be keeping an eye on that. And so, there's going to be a real push to try and get price above $1. But then once it does get above $1, there's going to be a real incentive by that, short interest, from over here, 30%, to then drag it back down. So $1 is going to be a pretty important level to be paying attention to. And let's see. Saul is saying that he lives in the Bay Area. Everywhere Saul goes, sees ChargePoint station. That's awesome. One of the grocery store I walk through a park that I live by to do some grocery shopping. And there's a gas station that has Tesla chargers, but then in the parking lot, they have a couple, at least I think 3 ChargePoint charging stations that are actually connected to a little solar panel as well as wind turbine thing. So I think that's pretty cool. And I do see cars plugged into them. So that is nice to see. And I live in a pretty small college town. So to see ChargePoint and to see people be using it is, I think, a really good sign. Jose says, anyways, what do you think about John Cena turning heel? I don't know what that means. Let's see. And Saul is saying stations, ChargePoint stations, yeah. Oh, yeah, Saul, I understood that. Thanks for the ChargePoint earnings call. No problem, Saul. Happy to do it. And so I don't know about John Cena, what he did. So I can't comment on that. But yeah, I mean, I think I might, log off before it gets too late. I want to unwind a little bit, relax, play some video games, and maybe catch up on some videos. I'll flip this back over to the minute. But yeah, I mean, we have held this blue line, so I think that's good. 66.20, I mean, I think that like 66 where we closed at, I think that's probably going to be like a dip buying level. But if it goes lower, be prepared for that as well. Because, we did put in some new, I believe, all-time lows, at least 52-week lows of 55.76 cents just a few days ago. And markets are volatile right now. Let's see, I'm just going to open up the pre-market prep stuff that I cover. We can see the volatility index. That looks like it's put in a topping signal. I didn't really mark the top of it that well. Could have made more money if I had more conviction in it getting up to 40, but the SPY looks like it did close 1% down, but this is a spinning top. So that could be suggesting a reversal that a potential bottom is in. After hours does look like it's up 3%, being above 580, which is, still below the 786 here at 583. But I mean, I think that we're going to be seeing some bounces and stuff. So good to keep the chins up, good to be nimble, good to have a plan, and to take profits when one can, whether that's ChargePoint or whatever. And also just so one's ready to buy the dip. I wanted to buy the dip more aggressively today. I did on some stocks, but not as many as I would have liked. ChargePoint being one of those I would have liked to buy more of, but I didn't actually buy the dip at all today for ChargePoint. But yeah, let's see. And Jose saying, I don't follow, that he follows WWE. I personally don't follow WWE. I can look it up though. Yeah, take care, Saul, if you're heading out. I'll look up the John Cena thing because I don't know about it. And then I will sign off. And so let's see. John Cena turned heel. I don't know what that means, to be honest. Yeah, I didn't even know he was still wrestling. I thought he was just like acting. Cena heel turn, gets trading card treatment from Topps. That could be good for GameStop. Turned a heel. Yeah, the meaning explained. I have to look this up. Turned a heel, an unexpected WWE move. What's this mean? For more than 20 years, John Cena established himself as one of WWE's ultimate good guys, a 16-time world champion who preached hustle, loyalty, and respect. That's why it's so shocking when Cena did something so disrespectful at WWE's Elimination Chamber event in Toronto on Saturday, March 1st, moments after he won the men's Elimination Chamber match to earn the opportunity to face undisputed WWE champion Cody Rhodes at WrestleMania 41 in Las Vegas coming up in April. Rhodes joined him in the ring. Rhodes wasn't there just to congratulate Cena. He was also there to respond to Dwayne "The Rock" Johnson's demand that Rhodes sell his soul to him. If that sounds unusual to you, well, you just don't. You just know that it's not strange in the world of professional wrestling. I don't follow anymore. I did when I was, I think in like middle school, maybe in elementary school, but not so much anymore. The Rock emerged from the backstage with rapper Travis Scott, asking Rhodes for his answer. Rhodes declined using colorful language, and Cena celebrated behind him. Cena then hugged Rhodes, I believe pictured here. But as they embraced, his smile transformed into a more sinister expression. He looked at The Rock, who made a throat-slashing gesture. That was Cena's cue to kick Rhodes in the groin. Oh my gosh. To utter shock of the live crowd, then proceeded to hit Rhodes with objects, including Rhodes' championship belt. Dang. In short, Cena turned heel, a wrestling phrase that indicates a good guy becomes a bad guy. And so that's some drama there. It's been the talk of wrestling fans since the event, with some comparing the moment to the time another wrestling hero, Hulk Hogan, famously turned heel in the 1990s. I remember Hulk Hogan back in the day. I think they had like Stretch Armstrong type of stuff that was kind of modeled after him. This is what actually happened. And so I did not know what that meant. I just got educated on that. And, I'll pull back to the chart here. SPY over here, and I guess I should pull back to my stonks list. ChargePoint up 1.85% in the after hours after being up almost 10.5% on the day. Can we reclaim these levels, get above the 21-day moving average? I think that would be really good. That is at about 76 cents. And then the 50-day moving average is around 95 cents. And of course, we need to be getting above the magical number of $1 a share. So let's see if that can happen over the course of the next week. And let's see. Jose, hopefully you enjoyed my analysis of the WWE drama. I'm not that familiar with it. But I didn't realize that The Rock and John Cena were still involved. So I think that's pretty cool. And I'm glad that people are excited about that stuff. And that could be good for, companies like GameStop as well. If there's more excitement around stuff where trading cards might be involved, that would be good for them. But anyways, I am going to get signing off to do some fun grocery shopping to get ready for my week, which is a 2-day week, starts tomorrow and goes till Thursday, 12-hour shifts, so it sucks. But anyways, that was a throwback to a little a screenshot I took of myself with the channel from maybe a year ago. But anyways, as always, those are just my thoughts. If you found them helpful, make sure you like the video, share your thoughts in the comments down below, and make sure you subscribe to the channel for more videos like this and likely more coverage of ChargePoint and your other favorite stocks. Thank you so much for watching. Have a great rest of your day. And please remember to manage to have some on the side for buying the dips when it dips lower than you expect it to dip, and to take some risk off the table when you're in a position to trim. I trimmed a little bit today. I took some profits today, not with ChargePoint. I sat on the sidelines and I did buy some dips, but not too many because I didn't have enough on the side. So always good to plan for that. Take care, you guys. I'll see you in the next one.